Inflation has become a major problem in most parts of the world and also in India. Inflation in India is now above 6%. In Europe, it is above 5%. In US, it is at a 40-year high of above 7%. The American Central Bank Fed has already started tightening monetary policy by raising interest rates in March. Therefore, this year is likely to witness central banks tightening monetary policy, that is, raising rates across the world. In India, RBI has been following a pro-growth monetary policy after the outbreak of the pandemic. In the last monetary policy announced in February, the Monetary Policy Committee kept policy rates unchanged. That is, repo at 4% and reverse repo at 3.35%. Also, the RBI declared that the central bank will continue with the accommodative monetary policy stance as long as necessary. This is a reflection of RBI's priority of growth over inflation. Therefore, it is possible that the Monetary Policy Committee may not raise policy rates in the April 8th policy. This is the high possibility. But the RBI, the Monetary Policy Committee, will have to raise rates this financial year twice or even thrice to tame inflation, particularly if the crude prices remain above $100 for an extended period of time. RBI's target for inflation for FY23 was 4.5%. That was when crude was trading at $90. Now crude is above $105, and therefore it's quite possible that for financial year 23, inflation is likely to be above 5.5%. So even though the RBI will be forced to raise rates later this financial year, the RBI raising rates in the April 8th policy is a low probability event. If the Monetary Policy Committee raises interest rates, it will have a negative impact on markets, and that negative impact will be temporary, not a lasting impact. The market is likely to be influenced more by news relating to the war, crude prices, metal prices, and trends in the global stock markets. If the RBI raises rates, rate-sensitive sectors will be impacted. Rising rates are negative for auto ancillaries, and the construction sector. Banks will have both positive and negative impact. The negative impact will be due to high interest rates leading to lower demand for credit. Again, negative impact can come from the decline in treasury income of banks. When interest rates rise, bond prices will decline and there will be treasury loss for banks. But there will be a positive impact too, because when interest rates rise, interest rates on loans will rise faster, fresh loans. The rates will rise faster than interest rates on deposits. Therefore, profit margins can actually increase. Now, even if we have rate hikes, the negative impact of rate hikes can be offset by momentum in economic growth. Investors should prioritize or give more weight to sectors which are not sensitive to inflation and interest rates, like telecom, pharmaceuticals, and IT. Even rate sensitives like financials can be considered because financials are fairly valued even now.